US markets, developed markets, emerging markets, farmers markets. What does that mean when it comes down to your investments? For a long time, it really didn't matter too much to investors. The reality was that the United States markets dominated investors' portfolios because it was such a strong economy and considered to be the world's greatest growth engine. However, there's been a shift over the past decade or more. The past few years have shaken up what was once the easiest decision in investing, keeping most of your investments tied to the US market. Now, with major geopolitical issues and scrutinized leadership across the markets, investors must understand how to navigate the US, developed, and emerging market investments, and how that might play out in their portfolios in the future. We don't have to worry too much about farmers markets because they're not really that involved in investing, but they're a great place to get fresh and local produce. This video should give people a general idea of what these three markets, of course excluding farmers markets, are, how they should be considered for their investments, and the best ways to consider them. I saw over the past few years that more investors were having larger positions or concentrations outside of the US markets and into ex-US developed or emerging market investments. This has had some good results, as I've seen, and I even do this for myself, but it may or may not be the best decision for everybody. The US market refers to, of course, the largest market in the world when it comes to stocks, bonds, currencies, and more. That is due to the sheer size of the US economy and its highly regulated and respected nature. It consists of assets and exchanges that operate in the US, including but not limited to the New York Stock Exchange and the NASDAQ exchange. It is regulated by the Securities and Exchange Commission, which is an independent federal agency tasked to protect investors and maintain fair and efficient markets. Here's the key issue that's arising, in my opinion. Due to the US administration's stance and actions on weakening the abilities of independent agencies and their moves to enrich the already well-off 1%, the US markets have become more heavily scrutinized. Tie that together with the AI bubble that keeps on getting larger every day, the lack of major corrections, and a horrifying global trade war currently ensuing, the US markets become worrisome to be 99% of anyone's given portfolio. You just have to have a lot of conviction, which is really hard during this time period. It's been rough to watch as a financial professional and an ex-financial advisor. Now, let's move on to developed markets. So developed markets actually include the United States, the United Kingdom, Japan, Australia, and many more countries, which are mostly US allies. They refer to countries with industrialized economies, strong political and legal systems, and robust tech infrastructure. Companies headquartered in these markets operate in established economies and have access to highly developed financial systems. Investments in these countries are considered to be less risky than investments in emerging markets. All investments, of course, have risk, and the more risk we take, the higher rewards we should be able to assume, but we also have the chance to lose it all. Emerging markets, on the other hand, are countries that are considered to be undergoing rapid economic growth, especially ones that are classified as having medium levels of income and that have some, but not all, the characteristics of a developed market. Some of the countries included on this list are Brazil, Russia, India, China, and South Africa, currently referred to as BRICS. Personally, I find it wild to see China still on the emerging markets list. My wife and I, we were there just last year and my first time there, and it blew my mind how advanced their cities were. Now that we know what US markets, developed markets, and emerging markets are, what the heck does that actually mean for your investments and you? It means, from what I can understand, the rest of the world is catching up. Mini history lesson for you. After World War II, the US could have taken over the rest of the world, which was ravaged by the horrors of warfare, but instead, it decided to support and protect trade and foster a new economic global order. With that, the US became the center of it all. It provided monetary options and protected trade lanes for the countries looking to rebuild. They were able to industrialize and sell the much needed goods to rebuild globally and become an even more dominant economic Goliath. However, since then, the other countries have rebuilt, established their own markets, and begun to decrease the economic gap. This has caused prices to rise rapidly in the United States, and it's felt even harder as wealth inequality rose. I can touch on this in a different video, but that is a completely wild ride. Regardless of the smaller gap, the United States still held trade powers that allowed it to be the focal point of the global economy. That is, until recently. Now, many of our closest allies and valuable trade partners have begun to make trade deals that were once thought impossible. Some of them have even begun to shun our markets in a sense. Now, it's tables and numbers time, which is everyone's favorite. Quick read of this table. Over the last 10 years, the United States has been the strongest long-run growth engine here. Looking at the last 5 years, that is still true, and the US is ahead, while developed ex-US and emerging markets have lagged. But this last year flips the story. emerging and developed ex-US investments have outperformed the US by a lot. This has been interesting to watch, and that's why diversification matters. I am in no way saying that this is what the trend is going to be. As I mentioned, it's a shift in the economic winds, and we don't know if it's going to be a small breeze or a larger climate change. If you're following along with my chain of thoughts, you could probably see where I'm going next. I believe the US market is an amazing growth engine, but the challenges it faces today make it harder to believe it as the one-stop shop for wealth creation. Non-US developed and emerging market investments have done well recently and may do so in the future due to this shift. If you're an active investor, one that is looking to be more current or working with a professional, this is something that you need to keep an eye on and learn more about. Maybe add a defensive position, however big or small you choose. If you're a passive investor with more than 2 indexes or ETFs, you might want to look into how 1 or 2 non-US indexes or ETFs could help you diversify in case of any major shakeups in the market. The size of this investment in your portfolio truly depends on your risk tolerance, your goals of growth, income, or stability. I personally feel that the US markets are so weighted by the Mag 7 stocks and this AI craze that I sleep better with a diverse investment pool that isn't tied to a bunch of billionaires passing a buck around. There's no guarantee that any of these will do better or not. It's about investing in a way that allows you to filter out your emotional decisions and grow your wealth with your personal plan. Some people love passive funds while others love individual assets. Investing is about looking at what's going on and putting your money in something that you believe will grow, pay out, or stay safe. I hope this was helpful to you, and please, if you could like and subscribe, it will help me continue to make these videos. Let me know your thoughts if you're interested in more US markets, developed markets, or emerging markets, or a diverse focus for 2026 and beyond. Please reach out if you have any questions or topics that you want to go over or chat about. Also, let me know if you want to be a guest on my new series, helping people figure out what their Build a Wealth goals are and the plan to get there. Subscribe and reach out to be selected for a free coaching session to get you pointed to where you want to go. As always, this is for educational purposes. This is not intended to be financial advice or investment advice. Please reach out to a professional if that's what you want to do.